So thinking about the market impact, it would be very tempting for an investor to see all of the headlines just being dominated by the invasion and the buildup to invasion, and conclude that much of the volatility that we've seen in the markets was due to the buildup and the invasion, due directly to that. I think it's really important to note that there wasn't just the one shock, the shock of invasion and that geopolitical shock. Prior to that, there was really a Fed shock that from the standpoint of markets actually might be more impactful. And that prior shock, I'll call the Fed shock. And the Fed shock was really, in some ways, it was a change in the stance of the Federal Reserve and how they viewed the persistence or the potential persistence of inflation and what they should do about it. So coming out of the pandemic, we saw, very predictable inflation in certain areas of the goods and services, and we saw inflation levels that were above target levels of the Fed, 3, 4, 5%. But the Fed felt, and I think reasonably so, that those could be transitory. But then we began to see that they weren't as transitory as the Fed had hoped. We saw levels of inflation that got up to 6, 7%. We'll get another inflation reading tomorrow. We're recording this on Wednesday. And many observers think it will be between 7 and 8%. So the Fed decided to change its stance and decide that inflation was more broad-based, it was a problem, and it was a problem that needed to be acted on sooner rather than later. So they moved their first Fed funds move, very likely, we think, up from June, so this summer, to March, this month. And most, until very recently, most observers thought we'd see 7 increases in the Fed funds rate this year. Now that's really significant, right? It signaled the end of an era of easy money, which had a really profound impact on financial markets. And so what we're seeing is a real repricing as the Fed sort of moves away from this era of easy money. We saw a repricing of bonds in particular. We saw a repricing of what we would call long duration assets. This would include growth stocks that have a lot of their cash flows in the distant future. So they really sold off, whereas value stocks with cash flows that were more current in the more near term, those are things that did quite well. So a real repricing of financial assets, and something that was likely to continue were it not for the invasion of Ukraine. And what was kind of interesting about these two shocks is that one, the invasion of Ukraine actually served to soften the Fed shock somewhat. And what I mean by that is, prior to the invasion of Ukraine, we were going to see, I think, a fairly aggressive Fed, a Fed that saw underlying growth is quite robust, right? And it was. We saw very tight labor markets, strong consumer spending, wage growth for areas of the labor market that hadn't seen wage growth for quite a long time, strong corporate balance sheets, and very strong corporate earnings. So a strong underlying backdrop. So likely we were to see a very strong Fed increasing interest rates to contain inflation. With the invasion of Ukraine, it caused the Fed and most market observers to think that instead of seeing 7 interest rate increases, we're likely to see 5. But perhaps more importantly, we're likely to see a far more cautious Fed as they keep one eye on growth and make sure that any interest rate increases don't push, for example, the US economy or the European economy into recession.